Welcome to Safe Simple Sound Podcast. I am your host, PK. Today we have an exciting episode lined up where we use AI voices to bring insightful discussions to life. But before we dive in, please note this podcast is for entertainment and educational purposes only and does not constitute financial, legal, or professional advice. Investment decisions should always consider your personal circumstances, financial goals, and risk tolerance. Be sure to consult a qualified financial professional before making any investment decisions. If you would like personalized guidance, you can reach out to me at savesimplesound.com/contact. Now, let's get started.
Welcome back to Safe Simple Sound Podcast. This is our last episode in the series on bonds. We started exploring the world of bonds with Sam and Taylor, focusing on why they can be a great addition to a portfolio, especially for those hesitant about the stock market's ups and downs. Taylor, you mentioned being a little wary of stocks, especially since you just landed your first job and want to start investing for a down payment.
Exactly. I have about $5,000 I'd like to invest towards a house in, say, 5 years. Stocks feel a little too risky for that goal right now.
That's a smart approach. And Sam, you are our expert on bonds. Can we delve deeper into the different types and how they work?
Absolutely. Think of a bond as a loan you give to a government or a company. They promise to pay you back the principal plus interest over a set period. We have government bonds, considered the safest, and corporate bonds, which offer potentially higher returns but carry more risk. Within those categories, we have different maturities, the length of the loan, from short-term, which can be a few months, to long-term, which can be 30 years or more.
So if I'm aiming for a down payment in 5 years, should I stick to short-term bonds?
That's a good starting point. Short-term bonds are generally less sensitive to interest rate changes than long-term bonds. This makes them a better fit for shorter-term goals like yours. We'll talk about interest rate risk in more detail later.
Let's visualize this with an example. Imagine lending a friend $100 for a year with a 5% interest rate. At the end of the year, you get your $100 back plus $5 in interest. Bonds work similarly, but on a much larger scale.
So what's yield? I keep hearing that term.
Yield is essentially the return you get on your bond investment, expressed as a percentage. It's influenced by factors like the bond's coupon rate, which is the stated interest rate, its price, and time to maturity.
Let's pause for a learning checkpoint. Taylor, can you summarize what we've covered so far about bond types and maturity?
Okay, so we have government and corporate bonds, which vary in risk. Then there are different maturity dates, from short-term to long-term, and yield is the return I can expect on my investment.
Perfect. Sam, you mentioned interest rate risk. Can you explain what that means for Taylor's situation?
Simply put, when interest rates rise, bond prices generally fall, and vice versa. This is especially true for longer-term bonds. Since Taylor's goal is relatively short-term, a strategy called laddering could be beneficial.
Laddering? That sounds intriguing.
Laddering involves buying bonds with staggered maturity dates. For example, you could invest a portion of your $5,000 in bonds maturing in 1 year, another portion in bonds maturing in 2 years, and so on, up to 5 years. This helps manage interest rate risk and provides more predictable returns. You could also focus on highly rated corporate bonds or government bonds for added safety.
This reminds me of what we discussed about diversification in earlier episodes. Instead of putting all your eggs in one basket, laddering allows you to spread your investment across different maturity dates.
So how do I actually buy bonds? Can I do it myself, or do I need a financial advisor?
You have a few options. You can purchase individual bonds through Treasury Direct for government bonds, or through a brokerage account for both government and corporate bonds. Alternatively, you can invest in bond ETFs, which are like baskets of bonds offering instant diversification.
And for a deeper dive into all of this, we recommend The Bond Book by Annette Thau. It's a great resource for beginners.
My friend Jim has been thinking a lot about how to apply saving for future to his situation. Jim and his wife have 2 young kids, and college seems a long way off, but they know it's important to start planning now.
Absolutely, Taylor. Starting early is key. It allows the power of compounding to really work its magic. 15 years is a good time frame to accumulate a significant nest egg.
Exactly, Sam. It's like planting a small seed that grows into a mighty oak over time. So, let's discuss some concrete steps this family can take. Sam, where should they begin?
A good starting point is understanding their risk tolerance. Since they have a moderate risk tolerance, building a diversified portfolio with a mix of stocks and bonds is a sound strategy.
This reminds me of what we discussed balancing risk and reward. Stocks offer higher potential growth, but bonds provide stability, right?
Precisely. And within bonds, there are different types. Given their long-term goal, intermediate-term municipal bonds could be a good fit.
Let's unpack that, Sam. What are municipal bonds, and why are they particularly suitable in this case?
Municipal bonds are issued by state and local governments to fund public projects. A key advantage is that the interest earned is often tax-free, at least at the federal level, and sometimes at the state level too. This can make a significant difference in long-term returns.
So if I understand correctly, the tax advantage boosts the overall return compared to a taxable bond with a similar interest rate.
You got it. Now, before we move on, let's recap. Diversify with stocks and bonds. Consider intermediate-term municipal bonds for tax advantages. Alex, what's next?
Great summary, Sam. Now, knowing how to invest is only half the battle. We also need to know how much to invest. Calculating future college costs is crucial. There are online calculators and resources that can help project these expenses.
That's really helpful, Alex. College costs seem to be constantly rising. Knowing a target amount gives us something concrete to aim for.
Indeed. And another option they could consider is age-based target date funds. These funds automatically adjust the asset allocation, gradually shifting from a higher percentage of stocks to a higher percentage of bonds as the target date, which in this case the year the children start college, approaches.
So it's like setting the investment strategy on autopilot, becoming more conservative over time.
A good analogy, Alex. It simplifies the process, especially for those who prefer a hands-off approach.
This is all starting to click. Diversification, tax advantage bonds, estimating future costs, target date funds. It feels much less daunting now.
I'm glad to hear that, Taylor. For those looking to dive deeper into bond investing, Annette Thau's The Bond Book is a great resource. It focuses on practical application and has a particularly helpful section on municipal bonds.
Absolutely. And as the children get older and the family's investment knowledge grows, they can explore more advanced bond strategies.
Before we wrap up this segment, any final thoughts, Sam?
Remember, every family's situation is unique. Consulting with a qualified financial advisor can provide personalized guidance. We at Safe Simple Sound provide personalized guidance. Reach out to us at safesimplessound.com/contact if you need guidance.
Excellent advice, Sam. Next, we're diving deeper, exploring how investors can ride the yield curve, especially when we anticipate its steepening. Taylor, as our resident inquisitive learner, what's top of mind for you today?
Thanks, Alex. I understand how a steep yield curve means longer-term bonds offer higher yields than shorter-term ones. That makes sense, but how can an investor actually use that information? Like, if I see the yield curve steepening, what moves can I make?
That's a great question, Taylor. When anticipating a steepening yield curve, investors often consider two main strategies: the barbell and the bullet.
Barbell and bullet? Those sound like workout terms.
Finance loves its metaphors, doesn't it? Sam, can you break these down for us? Maybe start with the barbell?
Sure. Imagine a barbell, weight concentrated at both ends. A barbell strategy involves investing in very short-term and very long-term bonds, avoiding intermediate maturities. This allows you to capitalize on higher yields at the long end while minimizing interest rate risk at the short end, which resets quickly as interest rates rise.
So if I expect the yield curve to steepen, I buy long-term bonds to lock in those higher yields before they fall, and short-term bonds to reinvest at even higher rates as they rise.
Precisely. For example, you might buy a 2-year Treasury note and a 30-year Treasury bond, avoiding maturities in between.
This is where Crescenzi's The Strategic Bond Investor book comes in handy. He offers insightful analysis of such strategies.
That reminds me of what we discussed about duration in previous episodes. Doesn't a longer maturity mean higher duration and therefore higher risk?
Correct. Longer-term bonds have higher duration, making them more sensitive to interest rate changes. However, the steepening yield curve environment often compensates for this increased duration risk with higher returns.
Think of it like a seesaw, Taylor. The higher yield on the long end balances the higher risk from duration.
Now let's move to the bullet strategy. This concentrates your bond holdings around a specific maturity, like aiming for a bullseye. It's suitable when you have a specific time horizon for your investment, say 10 years. So
if I need the money in 10 years, I'd buy bonds maturing around that time, regardless of the yield curve's shape.
ideally, you'd time your purchase when the yield curve steepens, improving the yield you'd lock in for those 10 years. For instance, if you anticipate rising rates impacting 10-year bonds the most, concentrating your investments around that maturity can maximize your return if your prediction is accurate.
Let's pause here for a quick recap. We've discussed two key strategies: the barbell, spreading investments across short and long maturities, and the bullet, focusing on a specific maturity. Both aim to capitalize on a steepening yield curve, but the barbell accepts more interest rate risk for potentially higher returns.
This is making more sense now. So how do we quantify that interest rate risk? You mentioned duration, but I remember there was another term, convexity.
Taylor, you brought up a crucial point: convexity. Sam, can you help us connect duration and convexity to these yield curve strategies?
Absolutely. Duration measures the sensitivity of a bond's price to interest rate changes. Convexity refines this by accounting for the curvature of the price-yield relationship. A bond with higher convexity offers greater price appreciation when interest rates fall and less price depreciation when rates rise, compared to a bond with lower convexity, even if they have the same duration.
So if I understand correctly, a barbell strategy with its long maturity holdings inherently has higher duration and potentially higher convexity, providing more upside potential if the yield curve steepens as predicted, but also more downside risk if it doesn't.
Precisely. Quantitative analysis, involving scenario modeling and looking at expected returns under different yield curve shapes, can further refine these strategies. This helps estimate potential returns and manage risk more effectively.
And this is where choosing the right resources is crucial, like the books we recommend. While the bond book offers a solid foundation, the strategic bond investor goes into more depth on actively managing interest rate risk with duration and convexity.
This has been incredibly helpful. I'm starting to see how these seemingly abstract concepts can have real-world impact on investment decisions.
Excellent. So, key takeaway for today: riding the yield curve involves strategic positioning with either barbell or bullet strategies, informed by concepts like duration and convexity. I know some of our listeners are curious about more advanced strategies, so today we're going to tackle a particularly interesting one with Sam: credit spread arbitrage.
Always happy to unpack these concepts.
This is exciting. In previous episodes, we talked about how bond prices move inversely with interest rates and how credit ratings influence yields. This reminds me of the risk-reward balance we discussed, with higher yields potentially meaning higher risk. So, how does credit spread arbitrage fit into that?
Excellent connection, Taylor. Credit spread arbitrage focuses on exploiting perceived mispricings between bonds with similar credit risks. A credit spread is simply the difference in yield between a corporate bond and a risk-free government bond, reflecting the additional risk of default associated with the corporate bond. Arbitrage in this context means profiting from these price discrepancies.
Imagine two companies, both with the same credit rating, but their bonds offer slightly different yields. This difference, the credit spread, is what arbitrageurs look for. They believe the market may be mispricing one bond relative to the other, presenting a profit opportunity.
So if I understand correctly, if two similar companies have different credit spreads, the arbitrageur buys the bond with the higher yield and sells the bond with the lower yield, hoping the spread narrows.
Precisely. They're betting that the market will correct the mispricing, bringing the yields closer together. Let's say Company A and Company B both have AA ratings. Company A's bonds yield 4% and Company B's yield 4.5%. An arbitrageur might buy Company B's bonds and simultaneously sell short Company A's bonds, anticipating that the 0.5% spread will shrink.
Let's pause for a learning checkpoint. Taylor, can you recap what a credit spread is, and the core idea behind credit spread arbitrage.
A credit spread is the difference in yield between a corporate bond and a government bond of similar maturity, reflecting the added risk. Credit spread arbitrage aims to profit from differences in yields between bonds of similar credit quality, betting on the spread narrowing.
Perfect. Now, Sam, what are some of the factors arbitrageurs consider when evaluating these opportunities?
They use sophisticated quantitative models to analyze bond valuations, assessing factors like interest rate risk, credit risk, liquidity, and market conditions. They need to be sure the spread difference isn't due to some fundamental difference between the companies that justifies the higher yield.
That brings up a good point. What about ESG factors? Do they play a role in credit analysis for arbitrage?
Increasingly so. ESG environmental, social, and governance factors are now being integrated into credit analysis. A company with poor ESG practices might face higher financing costs in the future, widening its credit spread. Arbitrageurs need to consider these long-term risks.
So, this is not just about crunching numbers. It also requires a nuanced understanding of the underlying companies and market dynamics.
Absolutely. Liquidity risk is also crucial. If an arbitrageur needs to exit a position quickly, they might face difficulty if the bonds are illiquid. This can significantly impact potential profits.
That's a key takeaway. While credit spread arbitrage can be lucrative, it's complex and involves various risks. Let's continue our deep dive into the world of bonds, specifically municipal bonds, with our expert Sam and our inquisitive learner Taylor. In the previous episodes, we talked about the general advantages of municipal bonds, particularly for those in higher tax brackets. Taylor, what's sticking with you from those discussions?
I think the biggest takeaway for me was how the tax-free income from municipal bonds can really make a difference for someone like our hypothetical high-income earner in a high-tax state. It reminded me of what we discussed about tax-advantaged accounts. Maximizing after-tax returns is key. But I'm still a bit foggy on how we actually compare the returns of a municipal bond with a regular taxable bond.
Great question, Taylor. Sam, can you walk us through that comparison?
Sure. Let's say you're comparing a municipal bond yielding 4% with a taxable corporate bond yielding 6%. To determine which is better, you need to calculate the tax equivalent yield of the municipal bond. This tells you what taxable yield you'd need to earn to match the municipal bond's tax-free return. It's a simple formula: municipal bond yield divided by 1 minus your tax bracket.
So if I understand correctly, if I'm in the 32% tax bracket, the tax equivalent yield of that 4% municipal bond would be 4% divided by 1 minus 0.32, which is about 5.9%, meaning the taxable bond at 6% would be slightly better.
Exactly. But remember, this is a simplified example. Factors like the creditworthiness of the bonds also play a role. A higher yield often means higher risk.
Right? We discussed bond ratings in a previous episode. A lower rated bond, even with a higher yield, might carry a significant risk of default. It's like choosing a slightly faster route that's more likely to have road closures. You might arrive quicker, or you might be stuck in a detour.
That analogy makes sense. And what about the AMT you mentioned previous episodes, Sam? How does that factor in?
The alternative minimum tax is a parallel tax system designed to ensure high-income individuals pay a minimum amount of tax regardless of deductions. Some municipal bonds, particularly those issued for private activities like stadium construction, can be subject to the AMT. This can negate the tax advantage, so it's crucial to know which bonds are AMT exempt before investing.
So, Taylor, think of it as a separate lane on that highway analogy. You might think you're in the express lane with your tax-free municipal bond, but the AMT can pull you into a slower lane unexpectedly.
Okay, starting to see the potholes on this municipal bond highway. So how can I research suitable municipal bonds? Are there bond screeners online?
Yes, many brokerage platforms offer bond screeners. They allow you to filter bonds based on criteria like yield, maturity, credit rating, and AMT status. This allows you to narrow down your search and focus on bonds that meet your specific needs. It's like using a map to find the best route for your trip, avoiding those potholes.
And remember what we covered in our discussion of Annette Thau's The Bond Book Taylor. She provides excellent guidance specifically on researching municipal bonds and treasury securities.
I think the bond book will be my next read.
Great choice. Let's switch our discussion to the topic of smart financial moves for entrepreneurs and diving into the world of bonds, specifically for managing excess business cash. Taylor, we talked about the importance of liquidity, right? How does that connect to our conversation today?
Exactly, Alex. We talked about how important it is for businesses to have cash readily available for unexpected expenses or opportunities. So, if we're talking about investing excess cash, we need to balance earning potential with being able to access the money quickly if needed.
Perfect. Sam, can you jump in here and tell us how bonds fit into this picture, specifically for an entrepreneur looking for tax efficient options?
Sure. One strategy is building what's called a laddered portfolio of short-term municipal bonds. Think of a ladder where each rung represents a bond maturing at a different time. This setup provides regular access to cash as the bonds mature. Plus, the interest earned on municipal bonds is often tax-free at the federal level and sometimes at the state and local levels, making them attractive for tax efficiency.
So, if I understand correctly, instead of putting all my eggs in one basket with one long-term bond, I spread my investments across bonds that mature at different times. This way, I have cash becoming available at regular intervals. Is that right?
Precisely. For example, you might have bonds maturing every 6 months or every year, depending on your projected cash flow needs.
This reminds me of what we discussed about diversification in earlier episodes, not putting all your eggs in one basket. Sam, can you elaborate on the trade offs between liquidity and yield with these short term bonds?
Absolutely. Generally, shorter-term bonds offer lower yields than longer-term bonds. This is because there's less risk involved. Your money is tied up for less time. So the trade-off is accepting a lower return for greater access to your funds. It's a trade-off our entrepreneur needs to consider.
That makes sense. Lower risk, lower reward. But what are some other options for short-term fixed income investments besides municipal bonds? You mentioned tax efficiency being a major draw. Are there comparable options?
Certainly, certificates of deposit, or CDs, are another possibility. They're offered by banks and also provide a fixed return over a specific period. However, the interest earned on CDs is generally taxable, unlike many municipal bonds, so the after-tax return might be lower.
Let's pause for a quick recap. We've talked about laddered portfolios of short term municipal bonds for tax efficient investing while maintaining liquidity. We've also touched on the trade off between liquidity and yield and compared municipal bonds to CDs. Taylor, any clarifying questions before we move on?
This is really helpful. I'm starting to see how these different pieces fit together for an entrepreneur managing their finances.
Taylor, you had some great questions about safer, more liquid bond alternatives, right?
Exactly, Alex. We talked about bond funds and ETFs, which are great for diversification, but I was wondering about options for someone a bit more risk-averse, maybe looking for a safe place to park their cash short-term while still earning a bit of interest. Something more like a savings account, but with potentially higher returns.
That's a fantastic question, and it brings us to certificates of deposit, or CDs. Sam, can you help us unpack what CDs are and how they work?
Sure. A CD is essentially a savings account that holds your money for a specific period, the term at a fixed interest rate. Think of it like a contract with the bank. You lend them your money for a set time, and they pay you interest in return. Terms can range from a few months to several years.
So if I understand correctly, it's like a time-locked savings account. I get a higher interest rate than a regular savings account, but I can't access the money until the term is up.
Almost. You can access the money early, but there's usually a penalty, often a percentage of the interest earned, or sometimes even some of the principal. That's why understanding the term is crucial.
Exactly. It's a trade off higher interest for less liquidity. Let's use an example. Say you have $5,000 and you put it in a 1-year CD with a 4% interest rate. At the end of the year, you'd get your $5,000 back plus $200 in interest. But if you need that money 6 months in, you'll likely face a penalty, potentially wiping out some or all of the interest earned.
This reminds me of what we discussed about bond maturities. Longer maturities generally mean higher yields, but also more exposure to interest rate risk. Is it similar with CDs?
Absolutely. Longer-term CDs typically offer higher interest rates, but you're locking your money in for longer. That's where the idea of laddering comes in.
Laddering is a strategy where you split your investment across multiple CDs with different maturity dates. Sam, can you expand on that?
Let's say you have $15,000 instead of $5,000. You could put $5,000 into a 1-year CD, $5,000 into a 2-year CD, and $5,000 into a 3-year CD. As each CD matures, you can either reinvest it at the prevailing interest rate or access your money penalty-free. This gives you a blend of higher potential returns from longer-term CDs and regular access to some of your funds as the shorter-term CDs mature.
So laddering helps manage both interest rate risk and liquidity needs. That makes a lot of sense. But how do I know what interest rates different banks are offering?
That's an important point. CD rates vary between institutions. Online banks and credit unions sometimes offer more competitive rates than traditional banks. It's essential to shop around and compare.
So if I understand correctly, CDs offer a safe way to earn interest, but I need to be mindful of the term and potential early withdrawal penalties. Laddering can help balance return and liquidity, and it's crucial to compare rates from different banks.
You've got it. So Taylor, in this series of episodes, we delved into the world of bonds, exploring different types and the factors that influence their prices. We touched briefly on alternatives to traditional bonds like CDs, and let's explore one more alternative, preferred stock. Sam, could you give us a quick overview of what preferred stock is and how it fits into the income-focused investor's toolkit?
Absolutely, Alex. Preferred stock occupies an interesting middle ground between bonds and common stock. Like bonds, preferred stock typically pays a fixed dividend, making it appealing to income-seeking investors. However, unlike bonds, preferred stock represents ownership in a company, similar to common stock. This hybrid nature gives it unique characteristics.
So if I understand correctly, it's like a bond because it offers regular payments, but it's also like a stock because you own a piece of the company. Is that right?
Precisely. Think of it like this. Imagine a company baking a cake. Bondholders are like lenders who provided the ingredients and expect a fixed repayment. Common stockholders are like the owners who get a share of the profits, which would be the biggest slice of the cake. Preferred stockholders are somewhere in between. They get a predetermined slice of the cake before the common stockholders, but their slice isn't as guaranteed as the bondholders' repayment.
That's a great analogy, Sam. So how does the fixed dividend payment work with preferred stock? Is it always guaranteed?
It's a good question, Alex, and leads us into the risks. While preferred stock dividends are generally prioritized over common stock dividends, they're not as secure as bond interest payments. Companies can, under certain circumstances, suspend or defer preferred dividends without necessarily defaulting, unlike with bonds.
This reminds me of what we discussed about credit risk with bonds. Does preferred stock carry similar risks?
Yes, credit risk is a factor. If the company struggles financially, it might not be able to pay its preferred dividends. That said, preferred stockholders have a higher claim on assets than common stockholders in the event of bankruptcy.
Let's recap quickly. Preferred stock offers regular dividend payments similar to bonds, but represents ownership like common stock. These dividends are usually paid before common stock dividends, but they aren't as guaranteed as bond interest payments. Credit risk is also a factor. Now, Sam, you mentioned interest rate sensitivity with bonds in our last episode. Does this apply to preferred stock as well?
Absolutely. Preferred stock prices are influenced by interest rates, much like bonds. When interest rates rise, the fixed dividend payments of preferred stock become less attractive compared to newer, higher-yielding investments. And as a result, the price of the preferred stock tends to fall, and vice versa.
So if interest rates go up, the price of preferred stock goes down, and if interest rates go down, the price goes up.
Exactly. Now, there's another risk specific to preferred stock called call risk. Some preferred stock issues are callable, meaning the company can repurchase the shares at a predetermined price after a certain date. If interest rates fall significantly, the company might choose to call the preferred stock and issue new shares at a lower dividend rate.
This adds another layer of complexity. So to summarize, we have credit risk, interest rate risk, and call risk to consider with preferred stock. Sam, before we move on, could you give us a simple example to illustrate these concepts? Maybe compare a preferred stock to a bond and a common stock from the same company.
Sure. Let's say company XYZ has issued bonds, preferred stock, and common stock. If the company performs well, all three investments could see positive returns. However, if the company struggles, bondholders are the most likely to receive their payments, followed by preferred stockholders, and then common stockholders. If interest rates rise, the prices of both the bonds and the preferred stock are likely to decline, while the impact on common stock may be less direct.
That clarifies things. So, while preferred stock can offer higher yields than bonds, it also comes with its own set of risks that investors need to carefully consider.
And with that, we've come to the end of our exploration of the bonds. Until next time, happy reading and profitable investing.
That's all for this episode. If you found it valuable, don't forget to subscribe to the podcast. For more insights, you can join my newsletter at safesimplesound.com. If you would like personalized guidance, you can reach out to us at safesimplesound.com/contact. Until next time, take care and bye for now.